Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is the former CFO of Silver Wheaton. He was the youngest CFO in the history of the New York Stock Exchange of a multi-billion-dollar company. He is the co-founder, president, and CEO of Sandstorm Gold now. Nolan Watson, thank you for joining me again.
Well, thanks, Jason. Thanks for having me.
Now, Nolan, finally, you've closed on this Mariana Resources deal. The UK regulators have finally given you permission, I guess, to talk about the deal. So, why did you do this deal? What do you like most about it? And what's the market missing about the deal?
Well, I think that the reason we like this transaction is because it is massively accretive to shareholders on an asset that is got a substantial amount of high-grade gold over significant widths. It'll be a low-cost producer. It's got very low capex. It's got everything that you could want in a mine. The ore body's 40 meters wide, and the heart of it is 14 grams gold equivalent, and it comes right to surface. Metallurgy is simple, so you're just floating concentrates. There's no cyanide used whatsoever. It's just one of those projects that you don't come across very often, and we're excited to have a portion of it in our portfolio.
Yeah, and you were able to add that growth at a huge discount compared to some of the other recent deals. Some of your peer groups of companies, the larger royalty and streaming companies, we've seen the headlines. They've been doing deals for over $800 million lately to add similar amounts of growth.
Absolutely. So Cisco recently did a transaction where what they're effectively getting is approximately 50 to 70,000 ounces per year of royalty income, and they paid $830 million. This interest for us, so we'll get annual payments based on the value of gold and copper sold, less cost of operations. And because the cost of operations will be so low, to the tune of $0 per ounce on a byproduct basis potentially, what we've effectively bought here is a royalty on a world-class asset that will give, to Sandstorm's credit, 70,000 gold equivalent ounces per year. So the same number of ounces per year as the Cisco deal. And what we paid was, depending on how you count it, was $200 million. So it's 1/4 of what Cisco paid. And part of the reason we were able to get that deal is because we got there first. We got a blocking stake in Mariana, who owned this asset, long before anybody knew what it was, and used that blocking stake to take over the company and get the asset.
Yeah, you had the royalty on the Mariana, on the Hot Maden mine from the Teck Resources package you bought, I think, towards either at the end of 2015 or the beginning of 2016. So you've been following that asset for a while now.
Well, exactly. It was funny when we started looking in that royalty portfolio that Teck sold us, kind of going down the list of things that we'd never heard of, going, what is this, and trying to do due diligence on them and research them, and we came across this Hot Maden thing. And when we realized what it was and realized how special it was, we immediately went out and bought a large stake in the company, and that has culminated over a couple of years into this transaction here today, and we're just incredibly excited about it at Sandstorm.
And this asset, compared to the other assets that Cisco bought in the package, I know you also looked at that deal. The assets that are in there, there's a lot of counterparty risk with juniors, which got Sandstorm Gold in trouble in the past. The assets, some of the royalties and streams there have buyback provisions, which are not good. It gives the miner the ability to buy back the entire stream. And then the assets in general are just not as good as the Hot Maden mine in terms of the geology, with exploration upside and grades and costs, correct?
Well, yeah, I think that's fair to say about almost all mines in the entire world. Very rarely do you find an asset that can have zero cost of producing gold on a byproduct basis, and very rarely do you find an ore body that's 40 meters wide with 14 grams gold equivalent. It really is a unique and special asset. The first drill hole went into the project only 2.5 years ago, and so we're in the very early days of understanding how much gold is actually on the property. And one of the things that we love at Sandstorm is giving our investors exposure to gold, not just the gold that we know about today, but gold through exploration upside. And the gold in that exploration upside is a very, very important part of our business model. And there's a huge land package here. It's a very prospective area. It's a very prospective asset. And so I think almost all other assets in the world pale in comparison.
Now, Sandstorm Gold has to be, since you guys don't have as much resources as say a Franco-Nevada, Silver Wheaton, Royal Gold, even Osisko. You guys have to be more innovative and creative in order to do deals and kind of, because if you're bidding dollar for dollar with those guys, you're probably not going to win. They can outbid you. You talked on the recent conference call, not the one today, but the one a couple months ago for the last quarter, about how the industry in general has gotten into a bidding war. The quality of assets has declined. Why do you think so many of these larger players are willing then to put up so much capital for such a low return? You said, you and Denver Harris said on the conference calls, 5% or less IRR on deals, sometimes almost 0% IRR, even a few deals recently that have been negative IRR. Why do you think people would be willing to risk so much capital, over $80 million on a deal for negative IRR?
Well, there's the existing players who are, the rates of return that they typically get depends on the number of deals that are being sold and offered by companies out there. And so when there's not very much capital in the mining industry and things are low and gold prices are low, there's plenty of deals to go around, and everybody sort of fills their boots with deals that are pretty good rates of return. It's times like this when markets aren't great, the equity markets are flowing well enough that the deals are infrequent when they come, and so it's been a while since everyone's done a deal, and they bid them up, and so you see those 3% IRRs and 4% IRRs. And there have been a couple of new entrants on the private equity side of the business, and we recently saw a private equity firm do a large deal that we viewed as a 0% IRR. And I actually asked the bankers who are working for them, why would anyone in the world do that? And the answer was, well, the plan is let's sell this asset and float it as a public company one day, and all precious metals and mining companies trade at significant premiums to the inherent net asset value with negative IRRs, and we'll be able to flip this asset for more than we bought it for. And I think that is a faulty presumption. Companies like Franco-Nevada and Royal Gold have worked very hard for very many years to build the portfolios that justify the valuations that they have, and it's not nearly as simple as that. So I think those business models are flawed and will fail. And so Sandstorm, how we compete in that environment, is doing exactly what you said, which is rather than competing head-to-head with them on assets that are well-known for processes that everybody knows about, we go and we try to get things before other people figure them out. It means we have to work harder, and we have to have a larger corporate development team than most of those other companies. Even though Sandstorm is 1/10 the size of some of those larger companies right now, our corporate development team is actually even larger, and it needs to be in order for us to get there first and find things that are smarter and more accretive for our shareholders.
Yeah, you guys have been doing well with your equity stakes on some of these juniors, and you've had a lot of your junior partners that you've been, getting little NSRs and little equity stakes in. They've been drilling a lot, so they've been able to go to the capital markets and raise a good amount of capital, enough to drill, but I guess not enough to build the mine yet, or they're not far enough along to build a mine.
Well, it's become a really interesting part of our business model, and we sort of fell into it a little bit of happenstance, but when we started focusing on finding really good exploration projects before the rest of the world has figured it out, and buying royalties on them, and then sometimes buying a little bit of equity in the company as well. And when they do have drill success, selling that equity for substantially more than we paid for it, and basically riding the royalty for free and collecting this portfolio of royalties as we go. One of the things that we found is that because we at Sandstorm have 41,000 investors now, our investors have been following what companies that we have been investing in, and have been doing more investments into those companies as well, which becomes a self-fulfilling prophecy. And now we're in a position where companies are chasing us down saying, please buy a royalty on our property because we want your investors to pay attention to us. And so it's giving us a significant number of opportunities that we didn't have before because of that self-fulfilling prophecy effect. So it allows us to really pick the best of the best in terms of exploration projects early on, and we've got a lot of people who are willing to sell us royalties for cheap because they want the Sandstorm effect, if you will.
That's a very interesting point. And for listeners who are not familiar, Franco-Nevada was not built in a day, just like Rome wasn't built in a day. It took many years to get Franco-Nevada up to the levels it is now. Sandstorm Gold, I think, has actually grown a lot faster in its first 8 years or so than Franco-Nevada has. And, Franco-Nevada bought some of those tiny little royalties you're talking about. You've, on your investor presentation, you call them acorns. Those things could grow into a full tree someday, and they could start throwing off, easily $1 million or $2 million a year in cash flow.
Yeah, and sometimes when we target an exploration project because we really like it, those projects tend to get drilled right away. But there are sometimes too when we buy portfolios of exploration royalties, and some of these projects we've never even really heard of. And the reason we're buying the portfolio might be because of royalty A and B, but royalty C, D, and E, even though we don't really pay much attention to them, they tend to surprise us. So I was actually going through earlier this week a list of properties that we have royalties on that have been drilled in the year 2007. And some of the drilling activity, in fact, I can't even remember the name of one of them, where there's 30,000 meters drilled on a property that I'd never even heard of. And we ascribed, I think, $10,000 of value to the royalty, and it's turning into a real project. And being able to be positively surprised for things that you basically bought for free is another important part of our model in delivering value to investors.
Yeah, there's a lot of optionality, I think, with Sandstorm Gold that the market is not giving the company credit for. You guys, I think there's a clear path now, Nolan, to you guys easily doubling operating cash flow by 2020, 2021, perhaps even tripling operating cash flow. You're around $50 million a year now in operating cash flow. There's a possibility you could even be over $150 million per year in operating cash flow if Hot Modern comes online around 2021. You don't need, the key point here is you don't need 2,000 gold or 2,500 gold. You have invested in high grade, low cost projects, so you can get that cash flow around current gold price.
Yeah, I don't say this very often, but I'd be willing to bet that even if gold prices go down, which I don't think they will, but even if gold prices go down, I think our share price is still going up. There's just that much latent value in the company. I mean, even at $1,200 gold, once Hot Bottom's up and running, based on Sandstorm's share price today, we'd be trading at 4.5 times enterprise value to EBITDA. So it only takes 4.5 years once Hot Bottom's up and running to cash flow the entire, basically, market cap of the company.
I told one of my private equity friends that was going to be Sandstorm Gold's future valuation after Hot Modern was online, and he said, no way. He said nothing sells for that cheap anymore in this environment where central banks are flooding the economy with cheap money and credit.
Well, sometimes things do temporarily until everybody figures it out, and then they stop trading at those levels.
Well, now, Nolan, I want to transition a little bit more to the overhead 30,000-foot view of the gold mining industry in general. What do you think of sentiment levels for gold, silver, and mining stocks? Do you think retail investors are extremely bearish compared to hedge funds and institutional investors?
Well, I think right now everybody's a little bit bearish and has been for quite some period of time. We had a little bit of reason for optimism recently, but I think continued rate increases by the Fed have taken the wind out of the sails of both institutional and retail investors. One of the things that we started to see back at the end of 2015 and the beginning of 2016 was generalist investors were starting to look to position themselves because they were underweight gold and position themselves in gold mining companies. And so there's this large rush of capital that came in towards the end of 2015, beginning of 2016, and that has almost entirely dissipated. In fact, a lot of those funds have unwound their positions, and we're still sitting here with a very apathetic market. It's very hard for small companies to raise money. If you're a junior mining company right now, good luck raising money. The big guys can still get access to capital, but it's at more depressed valuations than it was last year. And so I'd say the capital markets are alive, but barely with respect to gold.
Do you think it seems, Nolan, that there's a good amount of quality juniors that raise enough capital just to drill, but there's not really any capital to build a mine? So there's enough capital to drill and keep the junior running if they have a quality prospect to go out and drill more, but that's about it.
I would say generally, yes, that's absolutely right. There are a few exceptions to the rule, and those exceptions are when there's a reasonable project and people who are willing to believe it and back in it. So Trek recently raised $100 million, which was a complete abnormality in the mining markets. They're probably the only junior mining company that's been able to raise $100 million of equity, which is about their market cap at the time. Nobody else has been able to do that outside of Trek recently. And then you see other companies like Aleo, who's able to raise $50 million, but a lot of those other smaller ones they've gone and they built a book around a specific one or two funds who really believe in that one single project. Right now, the days of just launching a bought deal with a bunch of banks and expecting random strangers and random funds that you don't know of to buy your shares in that book those days are long gone. That is absolutely not happening right now.
Very, very interesting, because GDXJ has gotten hammered. Do you think also that's affected Sandstorm Gold a lot too with the GDXJ rebalancing?
Well, I know it has for the fact that on the day, or the 48 hours after the GDXJ announced the change in methodology, we were down 15%, and that continued to depress ours and other companies' valuations because there was a significant amount of time from the time they announced that they were going to be rebalancing to the time they actually rebalanced. And then it was a couple of weeks ago that they actually rebalanced, and we cleared our the 11 million shares that they owned of us, and it cleared after market. So that's now behind us, but it has definitely taken the winds out of the sails of a whole bunch of the gold and precious metal companies. My theory is that that there were actually funds pulling money out of VanEck and their index that tracked the GDXJ in advance of that rebalancing, which made it even slightly worse because there were less dollars in the funds to be invested in companies, and that's caused significant selling pressure. Going forward, I'm actually optimistic because that's not only is the rebalancing done, I think funds will start putting money back into the GDXJ, which means the GDXJ will have to go buy the shares of the junior mining companies. And I'm extra bullish on the Sandstorm side as well because with this Mariana transaction, they calculated how many shares to sell before we had issued the shares in the Mariana deal. Next quarter, so come September, they're going to have to redo their calculations of how much Sandstorm they have to own with the Mariana shares that we've issued in the denominator. So the GDXJ and the GDX are going to have to go out and buy a whole bunch of Sandstorm shares in September.
It's very interesting. Now, we've discussed in emails about Silver Wheaton and Silver Standard changing their names. Why, in your opinion, have they these larger silver companies had to change their names recently?
Well, I think the key to that question is in the question, which is why do the larger companies have to change their names? And the answer is the reason that they became silver companies in the first place is because silver typically has traded at a premium to gold on a NAV basis. So if gold companies trade at 1.5 times NAV, silver companies will trade at 2 times NAV. And hence you want to make as pure a play silver company as you can, and certainly Silver Wheaton grew up enjoying the benefits of that belief and love in silver by investors. The challenge is the silver market, those companies trade at NAV premiums because of the scarcity value in silver investments. There isn't a very large silver market around the world, and there are not very many silver companies that can be invested in, and there aren't very many silver mines out there to buy streams or to buy silver mines. And so if you're a Silver Wheaton or if you're a Silver Standard, once you reach a certain size, you can no longer grow at a reasonable rate staying only in silver, and so you have to move into gold. And that's what you've seen both of these companies do. And the name change is just a natural consequence of the fact that, hey, they're significant gold mining companies now instead of just silver mining companies. And I think that's a normal thing that you'll see is you can only get so big in just silver, and they've passed that point.
Do you think also that has to do with the fact that, we're actually now below $16 an ounce silver, that there's really just very few, if any, economic silver mines out there right now to invest in?
Yeah, there are only a handful of reasonable silver mines in the world. In Silver Wheaton's case, it's a bit different because they're able to buy the silver byproduct of base metal mines, and there are more of those, but still Silver Wheaton has even outgrown the ability to grow in just buying silver byproduct. So both companies have had to move into gold, and therefore they changed their names.
Yeah, Silver Wheaton now that they bought the gold stream from the base metal miner Vale, such a large amount of it, I think they actually have more annual revenues each year from gold than they do silver.
They do, yes.
So now I want to ask you about the mining industry in general. We've had these discussions every couple months when I have you on. Do you think there's a lot more cost for primary gold and silver miners to cut, or do you think they're running out of ways to cut costs?
I can promise you that 90% of the mines that we have seen and done due diligence on have cut everything that can be cut, and have also cut things that should not have been cut. So I think future cost reductions in the mining industry, unless we get into a deflationary scenario broadly in the economy, is not going to happen. Costs are going to be going up in the future.
So would you say then that unless gold goes, say, back to 1400, 1500, silver goes to 25 to 30, that the mining industry then is going to have a really difficult time either growing production and replacing reserves?
Absolutely. So we're at a place right now where the mining industry is doing okay. The people that have had a challenging time, they've already fallen away, and those of us who are left are doing fairly well. I think that mining companies that have high-cost mines, so let's say your cost of production is $1,000 an ounce or $1,100 an ounce, those companies are going to have a very hard time moving forward unless commodity prices go up, because inflation is still coming, and inflation in these developing countries is a lot higher than inflation is in North America, and these companies' costs are going up a lot faster than commodity prices are going up. So there will be a margin squeeze. Those companies will not be able to invest in the sustaining capital at the same pace that they probably should in a way that's healthy for the mine, and they will not be putting as many dollars into the ground drilling as they probably should in order to keep reserves up. So I think the industry, in order to be healthy going forward, needs higher gold and silver prices.
Yeah, I completely agree. I mean, oil costs, which are about a third, I think, of the cost to run a mine each year, the oil and energy costs are down. But, in a lot of these countries, whether it's South Africa or others, there's a lot of worker strikes, and the laborers pretty much want labor increases. So, I mean, it's kind of a situation where you would think rationally that the miners would have better margins with cheaper oil prices, but that's not been the case.
No, exactly.
Well, I want to ask you now about the comments that the CEO Franco-Nevada made. He said in March how the gold mining industry has no growth. They put their money where their mouth is. They've been making large investments now into oil and gas royalties. Do you agree with his comments?
Well, we talk with them on a regular basis, and we've actually even talked about that point with Franco-Nevada, and we would completely and wholeheartedly agree with them, generally speaking, that this is an industry that lacks growth. And the companies en masse, on average, don't have the capital to build the mines that they want to, and or the mines that they own. It doesn't make sense at today's commodity prices to build. And so I think it's pretty rare to see companies like Franco-Nevada that do have growth profiles, and even rarer still companies like Sandstorm, where we will have probably close to 120% growth in production based on things we've already bought over the next 4 years. We have the single highest growth profile of all streaming and royalty companies in the world right now.
Yeah, I saw this Bloomberg article in December of 2016, and I think it highlights the point that the CEO Franco-Nevada was talking about, and also what you've talked about in past interviews with me and also today, that the exploration budgets in general, whether it's from producing mining companies, they're just not spending as much of their free cash flow, if they have any, or operating cash flow on replacing reserves for exploration budgets. So there's a good Bloomberg article about this with 5 charts that's showing how much exploration budgets are down since 2006, how much CapEx has been cut, how reserves are not being replaced adequately. So, we're seeing these situations where Goldcorp, does a surprising investment, $250 million, I think, for a stake of a gold mining district in Chile that's not economic at current gold prices. And then you see a cautionary tale with New Gold with Rainy River, where they think that they're going to bring on an economic gold mine, and then there's problems, and now the mine's with huge capex overruns, and the mine's not economic.
Yeah, there's no doubt that the industry has been underinvesting for a while, and it's been doing that because of the economic climate. I would give advice to investors in relation to people who are thinking about buying commodity stocks, that although I do think commodity prices are going up, especially gold and silver, that you have to be very careful that if you buy a company who has high operating costs and they have debt, if it takes longer for the gold price to go up than we all think it's going to, those companies could go under before the gold price goes up. So don't get on the wrong side of that trade. My firm belief is that you want to buy companies that do have real leverage to gold, but are doing it with strong balance sheets and there's a reasonable cost of operations, such that if it takes longer for our thesis to play out on gold prices and silver prices than we think, then we have that ability to sit there and wait for that thesis to play out without getting killed in the meantime. So anytime you can get a company with low operating costs and a strong balance sheet, and just sit there and wait for the gold price to go up, I think that's a good thing, because I firmly and truly believe gold prices will go up, not only because of the things you've just mentioned with respect to underinvestment in the mining industry and declining production and declining reserves, but just also because of macroeconomic factors, and it's just a matter of time until the debt that this economy has saddled up comes back to bite us.
The gold mining industry has not done a good job of finding, high grade, low cost ounces, and they've made some really poor investments that have had to be written off over the years. And, I really don't know. I wanted to ask you about all-in sustaining costs. So, I think in past investors' presentations, I've looked at thousands of these things, and for many years, a lot of gold and silver miners, Nolan, only mentioned their cash costs. So you had to go and kind of calculate what their all-in costs were by hand. It was not always the most accurate. Do you think the all-in sustaining cost that the miners put out is a lot more accurate or very close to being, totally reality? And do you think that's better for investors, and do you think that's an accurate measure then for them to look at the all-in sustaining costs?
Yes, I would say it's not perfect, and there's certainly some companies that rig the numbers a little bit, and it's not comparing apples to apples across companies necessarily with respect to how those all-in sustaining costs are calculated. But what I would say, it is dramatically improved compared to what it used to be. I remember 10 years ago in the business when everyone just used cash costs, and CEOs would sit down with investors and say, look, my mine's going to have a cash cost of $300 an ounce, and then the investor would do the calculation and say, okay, well, gold's $500 an ounce, so you're going to make $200 an ounce, and CEO never mentioned the fact that sustaining capital was $150 an ounce, and that they were actually only going to cash flow one quarter what they were suggesting they were going to. And so the industry is a lot better off now that the standard is to disclose all-in sustaining costs. It's just expected by investors. If a CEO doesn't show it in their presentation, the investor is going to ask for it anyway. And I think we're way better off as an industry because we're being candid. And one of the things that it's brought to light is exactly what you've been talking about, which is there actually isn't a lot of profit in these gold mines, and the commodity price has to go up, or mines are going to be slowly winding down. And so it's an industry that is in desperate need of higher gold and silver prices, and I do think they're coming around the corner.
Yeah, I think there's been lying and dishonesty and fraud in the industry for pretty pervasive now for years. You did an interview on Kitco months ago, I think early in 2017, talking about juniors that, they're basically lying. Do you think then that's problems with the NI 43-101? Do you think then that the NI 43-101 and other either pre-feasibility studies or preliminary economic assessments, do you think that these problems with the juniors being dishonest with retail investors and their publicly released documents, those can be fixed then if rules were changed with the requirements then of the NI 43-101 and other things?
Well, I think we can always continue to make improvements to 43-101, but I don't think the fundamental reason that people are not being honest is because of weaknesses in 43-101. I think the inherent challenge is that whenever you have a limited amount of drill holes into a property, and you have a limited amount of metallurgical data, and you have a limited amount of engineering data, in every single set of assumptions that you make when determining how successful a mine is going to be, or what its cash flow is going to be, or what its production is going to be, in every single one of those data points, there's a range of reasonable answers. The problem is when there's 1,000 data points that you have to enter, and you take the most aggressive stance or the most optimistic stance for every single one of those data points, the conclusion that you come to in the end is 100% false. It's something that doesn't exist, and it's a fantasy. And I think that's the challenge right now with all technical reports around the world, whether it's 43-101 or JORC or whatever it is often you have executives who are not interested in showing an accurate, average, reasonable picture where the probability of it being better is equal to the probability of it being worse. Instead, they're showing a document that shows if everything was perfect in a perfect world and everything went right and all of my data came back on the high side of things, this is what theoretically something could look like, but in actuality it isn't. And so I just caution investors to be very, very careful that the 43-101 reports that they're making investment decisions are only as good as the integrity of the management teams behind those reports.
That's very interesting. It sounds like they've been cherry picking data, and a lot of retail investors have gotten burned by this over the years.
Absolutely, and they will continue to be. And that's one of the reasons. It's actually a phenomenon that happens a lot. Is what I would call the smart money in the industry, or the executives who are long-standing, who have good reputations for having integrity, who want to continue to do business for a long period of time, and therefore their incentives are to be honest and stay in business for a long period of time. They know who each other are, and what I found is that the smart money invests in other smart money. So you see CEOs in the industry who go, here's the 10 guys who I would invest with, and those 10 guys are all investing with each other because they know that each other are cut above the rest. And so that's one thing that I encourage people to do is find that list of 10 people and follow them and invest with them. And I'm not calling anybody out by name, but I think the smart money should follow the smart money.
The other thing, Nolan, that I notice is a very common occurrence in mining industry is that it seems that there's a huge underreporting of what the capex is going to be to build the mine. So whether it's a preliminary economic assessment, the pre-feasibility, those stages, it seems that some of these companies, Nolan, could underestimate their costs to build the mine. There's a lot of assumptions in there, like you said, cherry picking of costs and data. Maybe some costs are left out to where the costs are sometimes underreported by more than 40% to build the mine. And then, things can turn into the New Gold Rainy River scenario where the capex explodes and then the stock price absolutely crashes and then the mine's not economic at metals prices.
Absolutely. I think one of the areas where that happens a lot, and it's actually an important thing to take notice of because different mines have different exposures to this specific risk. So one of the things that happens a lot is that people underestimate the cost of burn and working cap when things take longer. So it's not that you bought a piece, you thought you were going to buy a piece of steel and it was going to cost X, and in reality it cost X plus 30%. That's not usually where the overruns happen. Usually what happens is you thought you were going to buy a piece of steel for X, you hired a team of 500 people to build the mine, and then the piece of steel doesn't arrive. And they sit there doing nothing for a month. And that cost wasn't factored in your study. And when you're putting tens of thousands of pieces together, that always happens to a certain number of them, and there are certain delays, and you have this burn. And then the second piece that gets missed is usually the working capital required. People in their wonderful Excel models, they tend to assume that the minute they turn the mill on, it's going to work perfectly, and it's going to start producing gold the very next day at a full run rate, and that never happens in reality. What happens is you turn your mill on, you realize here are the 400 things that aren't working right now, and you spend the next 4 months fixing them, and on a daily basis, your production gets a little bit better every single day. But lo and behold, you haven't really been producing much, if any, gold for the first 4 months, and sometimes in some mines' cases it's 9 months. And you wake up and you've burned through 9 months of operating costs and you have very little gold to show for it. And then the mine starts working. And it's just that working capital burn while you're waiting and fixing that just causes people to go bankrupt in the process.
Yeah, and there's no cash flow there. So, you're burning through capital and you're not getting the cash flow you counted on to start paying people off on the loans you had. So then, then your stock price is cratering and you're trying to sell equity at punitive valuations, or you're trying to take, debt. Almost all the mines I've seen, Nolan, I don't think I've seen a mine that has come in, way ahead of schedule, way under budget. I mean, maybe I think, the True Gold mine that you guys invested in for the gold stream, that mine was pretty much on time, pretty much on budget. But other than that, I really haven't seen that many that have come in, close to meeting the goals that were stated out in the feasibility study.
Yeah, we invested in a project that's a company called Silvercrest is building called Santa Elena, and I would say that one came in not necessarily on time, but it came in on budget. It was probably the only mine that I've seen in my career come in truly on budget. It's just something that, as you said, doesn't happen very often.
I want to ask you now about Cerro Moro, because, it's an enormous silver stream for Sandstorm Gold. I think it's a major catalyst for the company that the market is really not missing, is totally missing. It's not figuring it into the valuation for the company and all. It's going to be the largest source of Sandstorm Gold's annual revenues. So how far along is the Cerro Moro mine?
Yeah, it's a great question. I actually just had a conference call with a few members of Yamana's management team yesterday to ask them that very question, and they gave me a detailed walkthrough of where they are, and I think long story short is that there are public disclosures about them tracking well towards production in the middle of next year is still very much the case, and things are generally going well in that construction, and they should be pouring gold in 2018.
And Sandstorm Gold is going to get over 1 million ounces a year on the silver stream, right?
Correct.
Yeah, very nice. So, I mean, you guys the silver's coming online right as the silver price could potentially be bottoming out.
Well, one of the things I like about the asset is that it's got a number of years of operation ahead of it. We're doing a lot of exploration, and I think it's going to be a long life mine, and so I'm not super concerned about what the silver price is on the day they start it up, but what I'm more concerned about is ensuring that it's a long enough life mine, which I believe it will be, that when silver prices do pop, we'll be making a lot of money off of it.
Yeah, and it's going to be what, 11 or 12 million dollars in annual cash flow. That's the minimum that you guys are calculating right now. That's going to be the largest, before the Hot Modern project comes online. That's going to be the largest single source of revenue for Sandstorm Gold, right?
Yeah, absolutely. The Cerro Moro, Chapada, Hot Modern, and Diavik will be our largest producers as a company, and they're all large, low-cost, long-life assets with lots of exploration upside. So we really have transformed our portfolio compared to where we were 5 years ago.
Oh yeah, it's a totally different company. I mean, you guys are still looking for deals with juniors, but you're not relying on them nearly as much. The quality of counterparties that Sandstorm Gold has added is a lot better than it was in 2012 and 13.
Absolutely.
But yeah, I think the Cerro, I don't think the market is factoring this at all. That the Cerro Moro mine is currently under construction. You know, they're making progress. You guys potentially Q4, they're going to have the tailings dam done. They might start some of the mining by then. So in the first couple quarters of 2018, you could be ramping things up, and that would be quite a bit of extra cash flow then.
Yeah, so in 2018, we will be getting silver from the interim silver deliveries, and it's a hard start at January 1st, 2019 that we start picking up from Cerro Moro. There's also a chance that, because there's a test in our contract, they have to have the mill running at 80% of capacity before the contract kicks over to Cerro Moro ounces, and if they're not at 80% in the first few months of 2019, we would get an equivalent number of ounces from their already operating El Peñon mine. So anyway, either way, hard start beginning January 1st, 2019, we're going to get a bunch of ounces from one of those two assets, and prior to that, we'll be continuing to get the interim deliveries from Minera Florida and Chapada.
It's very interesting. So I think there's a lot of catalysts in the near future then for Sandstorm Gold. You talked about in recent interviews on Kitco and elsewhere that you're starting to buy back shares with free cash flow, not with debt. You know, not like some of these large corporations on the stock market that are using cheap debt to buy back stock. So I think it's important. There's a big differential then between buying back stock with debt and buying back stock with free cash flow.
Absolutely. Well, the mining industry is one where a lot of companies don't have free cash flow, and over the long term tend not to have very much free cash flow. And so there's a lot of mining companies that have share buyback plans and then never use them. And we absolutely plan on using our share buyback. In fact, with our permission to 1.5 million shares, our plan is to buy every single share back that we have permission for from the TSX. And like you said, we've got a lot of cash flow, and we think that's the best way to allocate it right now.
And that would limit the dilution then from the Mariana Resources deal that you just did. So anyone who was upset with the dilution, and obviously I was kind of initially upset before you explained to me about the Mariana Resources deal, and I started researching this more because in general I'm not in favor of dilution, but now you can go back in and start buying back the stock and reducing the amount of dilution.
That's exactly right. The headline for us was that this transaction gave us 100% increase in production for only 19% dilution. But when you factor in the share buyback, it ends up between the acquisition and the share buyback, what our shareholders will be getting is a 100% increase in production for only 14% dilution. So we think it's very accretive to them. So every Sandstorm shareholder who owns shares before we announce the transaction, they've got a lot more gold exposure per share now that we've done that, and especially now that we're starting the share buyback.
Very good. So, you've put together a bunch of different assets. You have the largest growth profile of any royalty and streaming company. So now it's just about, letting those assets mature and the cash flow, and then, start to reward shareholders. So hopefully in a couple years, you guys can implement a permanent dividend program. When the stock is cheap like it is now, you can buy back shares with free cash flow. You don't always have to do that. But, in this situation, you showed on your investors presentation how on a relative valuation basis, Sandstorm Gold is cheap compared to the others. Obviously, then, is a smart time then to go and buy back the stock now. If the stock is at a much higher valuation, it's smarter to use the capital for other things.
Exactly. And that's what we'll do.
My last question before I let you go is, besides, the share buybacks, what types of deals are you going to be looking at going forward? Are you going to be more conservative given how dangerous it is in this environment for counterparties and a lower gold price and the lack of quality assets out there? Are you going to be more conservative about doing any larger deals since you just did the Hotman one?
So I think what investors can expect from us over the next couple of years is probably similar to what we did over the last couple of years, but obviously market dependent. We are seeing a significant amount of really exciting exploration royalties, but they're really small dollars. It's $1 million here, $1 million there, nothing that moves the needle for us now unless we're right on the discovery, and then it'll move the needle from a NAV perspective. But so we'll focus on a few more of those royalty acquisitions. We are looking at a couple of larger transactions, but we're being very, very selective right now. We don't want to jump into a larger transaction unless we really like the asset.
That's fair enough. Yeah, it's a dangerous environment right now. I know there was a lot of deals available for, let's say, less than quality counterparties. So, it's smarter. I think you guys at Sandstorm Gold, from talking with you and seeing how you've improved your quality control process, the company has come a long way from the quality of deals they used to do years ago, that you guys are a lot more careful about the counterparties that you agree to deals with.
Yep, absolutely.
Well, Nolan, I want to thank you again for your time today. I enjoyed this discussion. Really excited that I got to talk to you about the gold mining industry for over 40 minutes. And if our listeners want to learn more about Sandstorm Gold, maybe read more about the acquisition, since you guys are putting up a lot of videos about the acquisition, you're interviewing your geologists. Last question: did you guys literally spend thousands of hours on due diligence on the Hot Modern transaction?
Oh, absolutely. It had our whole team bogged down for an extended period of time, every single individual in it. We stopped working on every project that we were working on and focused solely on this one, as well as all of our consultants, whether they be underground mine engineers or metallurgists or geologists. We pulled the entire team in, and they focused solely on this. So it's a record amount of due diligence.
Yeah, I can definitely tell the way you've been talking about the deal and the details that you've been releasing about the deal recently, and also the videos on YouTube that you've been sending out, that a record amount of due diligence was done on this deal.
Absolutely. And if people want to find out more information on that due diligence and that process and more about the asset, or even just more about Sandstorm, they can go to sandstormgold.com.
Wall Street for Main Street needs your help. YouTube stole $7,200 from Wall Street for Main Street in annualized YouTube AdWords revenues, and they kneecapped our analytics down by more than 80% across the board since September 2016 with their new censorship algorithms to stop the rapid growth of our channel. That was money we could have used to upgrade our website, pay bills, and invest in improving our content and growing our business. Our audience of loyal listeners is all over the globe, and so large now that if most or all of our listeners were to commit to donating $1 to $5 each month to our Patreon account, we could easily meet our goal on Patreon. Wall Street for Main Street also accepts one-time donations on our main wallstreetformainstreet.com website. That's WALL STFORMAINST.com website via PayPal, Gold Money, or Bitcoin. We also accept donations of physical precious metals that can be mailed to us. Thanks to all listeners who have already made a donation, and thanks in advance to any listeners who make a future donation or contribution to the growth, improvement, and success of Wall Street from Main Street.